Meet Alex. Alex is, statistically speaking, the unluckiest investor who has ever lived. He consistently misses market rallies and buys at the absolute peak, only to see his investments plummet. Alex isn't bad at saving money. In fact, he's great at it. He diligently puts away a portion of his income year after year. But Alex has a terrible secret. He is terrified of losing money. This fear dictates his every financial move. So he waits. He sits in cash, watching the market climb, waiting for the perfect moment to jump in. He believes he can time the market, predicting its movements to maximize his gains. He studies charts and news, seeking the ideal entry point. And every single time he finally builds up the nerve to invest, disaster strikes immediately. He jumps in, convinced this is the moment, only to be met with an immediate downturn, wiping out his initial enthusiasm. He climbs to the peak, plants his flag, and then the market collapses, leaving him stranded and disheartened. I'm talking about investing his life savings right before the crash of 1973, a truly unfortunate start to his investment journey. Then again, right before Black Monday in 1987. He had a knack for picking the worst possible times. Then the dot-com bubble. Each time, he was convinced he was making the right move, only to be proven wrong. Then the great financial crisis. Alex literally only buys at the absolute peak every single time for 40 years. His timing is consistently terrible, a pattern that repeats itself over and over, defying all logic and common sense. You would assume Alex died broke, his portfolio decimated by his unfortunate timing. But you would be wrong. You would assume his portfolio was decimated. But you would be wrong, because when Alex retired, he was a millionaire. He was a millionaire, despite his consistently poor market timing. How is this possible? The math will surprise you. Today, I'm going to show you the math behind the world's worst market timer and why being smart about entry points might be costing you a fortune. This sounds like a campfire ghost story for economists, but it is actually a rigorous data simulation created by Ben Carlson over at A Wealth of Common Sense. It's a stress test for the one question I get asked more than any other. The market is at an all-time high. Shouldn't I wait for a dip? It feels intuitive. We want to bargain, we want to buy low and sell high. This is the common wisdom, the gut feeling most investors follow. But the data I'm about to walk you through proves that your intuition is actually your portfolio's worst enemy. We are going to look at 4 distinct characters in this story. Each represents a different approach to investing, with surprising outcomes. We have Alex, the terrible timer. He embodies the investor who always seems to buy at the wrong time. We have Lucy, the impossible perfect timer. She represents the ideal, hypothetical investor who always buys at the absolute bottom. We have Susan, the boring, consistent investor. She represents the disciplined approach of regular, automated investments. And then we have the person most of us actually act like. Dave, the guy who stays in cash. By the end of this video, you are going to see a graph that changes how you view risk forever. Before we dive into Alex's tragic timeline, I want to ask you to do something that has a guaranteed ROI. If you appreciate data-driven stories that don't rely on hype or fear-mongering, go ahead and hit the subscribe button. It tells the algorithm that we want more signal and less noise in the finance space. I read the white papers, so you don't have to. Okay, let's go back to 1970 and meet Alex. Let's set the scene. It is 1970. Alex is 22 years old. He has just started his career. He decides he is going to be responsible. He plans to save $2,000 a year. Now, $2,000 in 1970 is real money. That's a new car. But Alex is nervous. The headlines are scary. So he puts that money into a bank account. He doesn't trust the stock market. He watches 1970 pass. Then 1971. The market is going up and he feels like he's missing out. Finally, at the very end of 1972, he can't take it anymore. The fear of missing out gets him. He takes his accumulated savings, $6,000, and he dumps it all into the S&P 500. It is December 1972. If you know your market history, you know that Alex just walked into a buzzsaw. Almost immediately after his check clears, the market collapses. We are talking about the brutal 1973-74 bear market, where stocks lost nearly half their value. Alex is horrified. But here is the key to Alex's psychology. And this is the one rule he follows that saves his life. Alex does not sell. He feels sick, but he doesn't hit the panic button. He endures the pain, trusting in the long-term growth of the market. After that burn in the 70s, Alex is traumatized. He goes back to saving cash. He doesn't want anything to do with stocks. He works hard, he gets raises, and he increases his savings rate. Throughout the 80s, he's saving $4,000 a year. He watches the massive bull run of the mid-80s from the sidelines. Finally, in 1987, the euphoria is everywhere. Everyone is making money, but him. He decides it's time to get back in. He takes 15 years of savings, a huge lump sum, and invests it into the S&P 500. The date? August 1987. The market peaks immediately, and 2 months later we get Black Monday. The market crashes over 20% in a single day. Alex has done it again. He bought the absolute top. But sticking to his rule, he grinds his teeth and holds on. He doesn't sell. He just goes back to work, saving his cash, waiting for the next time he feels safe. This pattern continues. He waits until the absolute peak of the dot-com bubble in 1999 to invest his 90s savings. Then he waits until October 2007 to invest his 2000 savings, right before the global financial crisis. He literally catches every falling knife, but he catches them by the handle. He holds on, refusing to panic sell. Let's look at the actual ledger here. Alex invested a total of 4 times over his career: 1972, 1987, 1999, and 2007. In every instance, the market crashed immediately after he bought. By the time he retires in 2013, he has contributed a total— That is the cash that came out of his paycheck. Now keep in mind, for huge chunks of time, his money was sitting in cash earning almost nothing. While he waited for these peaks, his timing was, objectively, an F-. If you were a fund manager with this track record, you would have been fired in 1974. But Alex isn't a fund manager. He's a guy who wants to retire. So we run the numbers using historical S&P 500 total return data, which includes reinvested dividends. We calculate what that $6,000 from 1972 is worth, plus the 1987 lump sum, and so on. Even though he bought at the highs, he never sold. He let the dividends reinvest. He let the decades roll by. When he checks his balance in 2013, what do you think he sees? A portfolio worth $1.1 million. Let that sink in. The world's worst market timer, a guy who only bought at the peaks of the worst crashes in modern history, is a millionaire. He turned $184,000 into $1.1 million. That is roughly a 6-fold increase on his capital. How is this mathematically possible? It comes down to the one variable that Alex got right. He got the timing wrong, but he got the time right. That money from 1972, it sat in the market for 41 years. Even though it lost half its value in the first 2 years, it compounded for the next 39. The money from 1987 compounded for 26 years. The sheer force of the market's long-term upward trajectory. The lesson here isn't that entry price doesn't matter. Obviously, buying lower is better. The lesson is that entry price matters infinitely less than holding period. Now I know what you're thinking. You're thinking, okay, Tom, Alex did well, but surely he left a lot of money on the table.
And you're right. But here is the twist. There is a character in the simulation who does worse than Alex. Much worse. And this character represents how most people actually behave. While we laugh at Alex for buying at the top, there is a legitimate danger in trying to be too smart.
We need to compare Alex to his friends to really see where the trap lies. Let's bring in Lucy, Susan, and Dave. Because if you aren't careful, you might think you're trying to be Lucy. But the math says you're probably going to end up like Dave. First, let's look at the fantasy. This is Lucy. Lucy is God's favorite investor. In this simulation, Lucy invests the exact same amount of money as Alex during the exact same years. But Lucy has a crystal ball. She times the market perfectly. She invests her savings at the absolute bottom of every crash. She buys the 1974 low. She buys the 2002 bottom,
She buys the absolute floor in 2009. Obviously, Lucy ends up with the most money.
In Ben Carlson's model, she ends up with just over $1.5 million. That is the ceiling. That is the absolute best-case scenario if you were a time traveler. But here's the comparison that matters. Alex, the idiot who bought the peaks, has $1.1 million. Lucy, the god-tier genius, has $1.5 million. The difference between being the worst investor in history and the best investor in history was not zero versus millions. It was the difference between being rich and being slightly richer.
The gap is surprisingly small considering how drastically different their strategies were. This is a crucial insight for every investor.
Now let's look at Susan. Susan doesn't care about the market. She doesn't watch CNBC. She doesn't look at charts. Susan just invests her savings every single year as she earns it. This is what we call dollar cost averaging, or DCA. She buys when the market is high. She buys when it's low. She buys when it's boring. She just puts the money to work immediately. How does she fare? Well, she ends up with about $1.3 million. She beats Alex, obviously, because she bought some shares at lower prices.
But she trails Lucy, the perfect timer. Susan is the baseline. She represents pure discipline without prediction. And notice how close she is to the perfect scenario. She got most of the upside of Lucy without needing a crystal ball.
But Alex, poor, unlucky Alex, is still trailing her by only a relatively small margin. This reinforces the idea that as long as you stay on the roller coaster. And finally, we have to talk about Dave. Dave is the one you need to worry about. Dave is the one who says, the market looks expensive, I'm gonna wait for a crash. But unlike Alex, who eventually buys, Dave keeps waiting.
Or perhaps he buys, sees a crash, gets scared, and sells to preserve capital. If Dave sits in treasury bills or a savings, if he stays in cash, he barely beats inflation. He ends up with maybe 400 or 100,000, depending on interest rate.
The prudent saver who stayed on the sidelines. This is the punchline of the entire study. It is better to be in the market at the wrong time than to be out of the market completely.
The opportunity cost of sitting in cash is the most expensive mistake you can make. Far more expensive than buying at a peak. I want you to visualize this bar chart. On the far left, you have the tiny bar for Cash Dave. Then you have a massive jump up to Alex, $1.1 million.
Then a small step up to Susan, $1.3 million. And a tiny step up to Perfect Lucy, $1.5 million. The huge leap happens simply by moving from cash to stocks. The incremental gains from getting the timing right. The data suggests that we spend 90% of our mental energy worrying about that small gap between Alex and Lucy, trying to optimize our entry,
when we should be spending 100% of our energy ensuring we aren't Dave. We obsess over the icing and forget to bake the cake.
But Tom, you might say, I can do better than Alex. I can jump out before the crash and jump back in at the bottom. That is the dream. But I have another set of data that makes this strategy look terrifying. It turns out, and missing the best days is lethal. Let's look at a study from Johnson and Zuba regarding the best 10 days of the market.
Here is the setup. They looked at daily returns over a 20-year period. If you just held the S&P 500 for the entire 20 years,
but if you missed just the 10 best days in that 20-year period, that's 10 days out of roughly 5,000 trading days.
If you miss the 50 best days, that's just 1% of the trading days. Your return collapses to roughly, think about that, 99% of the days were noise. The entire compounding engine of the stock market was concentrated in just 1% of the trading days. If you are sitting in cash waiting for the right time and one of those days happens, you can never get that return back. It's gone forever. Now, a counter-argument is, well, I'll just avoid the 10 worst days. And yes, the math says if you avoid the 10 worst days, your returns skyrocket. But here is the trap, and it's a nasty one. The best days and the worst days are roommates. They almost always happen right next to each other. JP Morgan Asset Management does a study on this every year. They found that 6 of the 10 best days in the market occurred within 2 weeks of the 10 worst days. In 2008, for example, we saw massive single-day crashes, followed immediately by massive single-day rallies. If you panic and sell on a Monday because the market dropped 4% and you sit in cash on Tuesday, you might miss a rebound. This is why timing is so hard. To time the market, you have to be right twice. You have to sell before the crash, and you have to buy back before the rally. And since the rally usually happens while the world still feels like it's ending, Almost no one has the guts to buy back in time.
Let's play out the psychology of a market timer. Let's say you are smart. You sell everything in 2007 before the crash.
You feel like a genius. The market drops 20%, then 30%. You are sitting on cash, feeling great. But when do you buy back? The news is terrible. Banks are failing. Everyone says it's gonna zero.
Do you buy then? Probably not. You wait for the dust to settle. You wait for confirmation that the economy is safe.
By the time the news looks good again, the market is usually already rallied 40% or 50% from the bottom. You missed the snapback.
This is why most retail investors underperform the very funds they invest in. Dalbar studies consistently show that the average investor...
They aren't losing money because the fees are high. They are losing money because they are jumping in and out, trying to outsmart a system that rewards patience, not activity. So what is the protocol here? It's what I call automated apathy. You need to structure your financial life so that you literally do not care what the market did today.
If you are contributing to a 401k, this is already happening. Now, you buy every 2 weeks, regardless of the headlines.
The goal is to maximize your time in the market. Every day your money sits in cash, you are fighting the probability that today might be one of those best 10 days. Bob became a millionaire because once he put his money in, he lost the password. He never sold. If he had sold in 1974 to stop the bleeding,
The protocol is simple. Buy right now. If it drops tomorrow, buy more. If it goes up, buy more. Just keep buying.
There is one final objection I need to address, and it's a big one. It's the lump sum problem. Let's say you sell a house or get an inheritance.
The market is at an all-time high. It feels reckless to dump it all in at once. Surely in this specific case, it is better to drip it in slowly over 12 months.
it feels safer. It feels responsible. But Vanguard ran the numbers on this too, and the answer might make you uncomfortable. Vanguard compared lump sum investing versus dollar cost averaging, or phasing in, over a 12-month period across 3 different markets. Their conclusion? Lump sum investing outperformed dollar cost averaging about 66% of the time. 2/3 of the time, you end up with more. Why? Because the market goes up more often than it goes down. If you decide to spread your investment over 12 months, you are keeping a large portion of your cash on the sidelines. If the market goes up during those 12 months, which is statistically the most likely outcome, you are just buying in at higher and higher prices. You are paying a premium for emotional comfort. Now notice I said 66% of the time. That means 33% of the time. But are you willing to bet against the 2/3 probability? However, we have to respect the psychology. If dumping $100,000 into today is... In this specific case, dollar cost averaging acts as insurance against your own behavior. It is mathematically suboptimal, but psychologically superior. If spreading it out over 6 months keeps you invested, then do it. But understand that you are paying a fee for that peace of mind in the form of likely lower returns. Just don't drag it out for years. The data shows that the longer you wait, the worse your odds get. So, let's bring it all back to Alex. Alex is a hero. Not because he was smart. He wasn't. He was a hero because he was stubborn. He endured the 1970s stagflation. He endured the 1987 crash. He endured the tech wreck. That stubbornness is the most valuable trait an investor can have. The media industry is built to destroy that stubbornness. They want you to click, they want you to trade, they want you to feel anxious. But the graph of Alice's portfolio is the ultimate shield against that anxiety. Whenever you feel the urge to time the market, just remember the red dots on Alex's chart. He bought the peak, he lost half his money on paper, and he still won. If you are young, market crashes are actually a gift. They let you buy more shares for the same amount of money. If you are older, a diversified portfolio protects you. But for everyone, the rule remains the same.
The only people who get hurt on a roller coaster are the ones who jump off while it's moving. Stay in your seat. Let the compounding happen.
Don't try to be Lucy. You don't need to be perfect to be rich. You just need to not be Dave. If this perspective on Alex helped lower your blood pressure about the current market highs, do me a favor and like the video.
It helps the channel grow and it helps me find more of these studies for you. And if you have a friend who is currently sitting in cash waiting for the election or waiting for the crash, send them this video.
It might save them a lot of money and opportunity cost. Thanks for watching, and I'll see you in the next one.
Remember, the market rewards patience and consistency, not frantic attempts to time its unpredictable movements.
So take a deep breath, trust the data, and let your investments work for you over the long term. The journey to wealth is a marathon, not a sprint. Don't let fear or greed dictate your decisions. Stay disciplined, stay invested, and stay calm. Your future self will thank you.
Start today. Don't wait for the perfect moment, because the perfect moment is now. Every day you delay is a day your money isn't compounding.
Only a narrator speaks and lip syncs. All other characters keep their mouths closed. Says take control of your financial destiny by an audit. Your journey to becoming a millionaire, just like Alex, starts with a single, consistent step. Make that step today. Don't let the noise of the market distract you from the power of long-term investing. The secret to wealth is simpler than you think. It's not about being the smartest or the luckiest. It's about being patient, disciplined, and staying in the game. That's the real hidden rule. So, what are you waiting for? The market is open. Your future is waiting. Take action now. Don't let another day of potential growth slip by. The power of compounding is on your side if you let it be. This video has shown you the undeniable truth. Time in the market beats timing the market. It's a simple yet profound principle. Embrace the long game. Ignore the daily fluctuations. Focus on your goals and let the market do what it does best: grow over time. Your financial freedom is within reach. All it takes is a commitment to consistent investing and unwavering patience. You have the power to make it happen. Don't be a Dave, paralyzed by fear. Don't try to be a Lucy, chasing an impossible ideal. The path is clear. The data is compelling. The choice is yours. Start investing today and watch your wealth grow. This isn't just about money, it's about peace of mind. It's about building a secure future for yourself and your loved ones. It's about living life on your terms. So close this video, open your brokerage account, and make that first investment. Or set up your automated contributions. The time is now. Don't let another moment of opportunity pass you by. The market is a powerful engine of wealth creation, and you deserve to be a part of it. Thank you for watching. I hope this video has empowered you to take control of your financial future. I'll see you in the next one with more data-driven insights. Remember, the journey of 1,000 miles begins with a single step. Make that step towards financial freedom today. Don't let the fear of the unknown hold you back. The greatest risks are often the ones we don't take. Invest in yourself. Invest in your future. The market is a long-term game. Play it with patience, play it with discipline, and you will win. It's not a matter of if, but when. So go forth and conquer your financial goals. The power is in your hands. Make smart choices and enjoy the ride. This video is a testament to the power of consistent, long-term investing. Share it with anyone who needs to hear this message. Let's spread the word about smart investing, free from hype and fear. Together, we can build a more financially literate world. Your journey starts now. Don't look back. The future is bright for those who stay the course. Invest wisely, live freely. Thank you for being a part of this community. Your engagement helps us create more valuable content. See you in the next video.